Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's early morning, Thursday, September 10th, 2015, and the title of this week's audio blog is Coming to a Head in the Next Few Months. Well, back on August 13th, I published Silver Supply a 1.5 or 2.0 out of 10, in reference to the words of Andy Schectman, Miles Franklin's president and co-founder, who has been selling precious metals for nearly 2 decades and has as reliable information about the physical bullion market as anyone on the planet. 2 weeks later, on August 28th, we taped Physical Gold and Silver Market Update, a special podcast with Andy in which he gave additional, extremely valuable commentary on the topic, including, I might add, not just the rapidly dissipating state of physical silver inventories, but the, as I had put it a day earlier, unprecedented universal fear he sensed in all manner of clients, even more so than during the 2008 crisis. Back then, he noted, the previous 7 years of precious metal price gains kept most people still in buy-on-the-dips mode, and thus, even amidst the worst financial crisis the world has seen since the dot-com bust, the majority of precious metal buying was, in his view, done for the wrong reasons, i.e., to profit from the expected bounce as opposed to protect one's assets from calamity, hyperinflation, or otherwise. Moreover, back then, as opposed to today, we were doing many very small orders, versus today, where average order size is vastly higher. In other words, a lot of small speculators were buying on the dip then, versus big money fearfully trying to protect assets today. Of course, as bad as things look then, they are orders of magnitude worse today. Global debt is at least 50 trillion higher, global GDP is dramatically lower, and far more so if honest apples-to-apples accounting were still utilized. Interest rates have been pegged to zero or lower in nearly every major economy, and yet, whilst the 1% receiving this free money have thrived, it has been at the expense of the 99%, as well as countless future generations. To wit, wealth disparity has never been higher, at least in modern, non-feudal times, nor has debt servitude in a world in which the average person will never be able to pay off their liabilities, where plunging real employment and real wages have not only become secular norms, but will only worsen as the most hideous economic oversupply situation since the Great Depression expands, let alone when global currency markets, already on average at an all-time low, really start to plunge. Back to precious metals. In the ensuing 2 weeks since our August 28th podcast, the Dow Jones propaganda average has violently surged and plunged, with said surges due entirely to relentless PPT support. Not to mention the equally heavy-handed policy response of the world's largest central bank, the PBOC, which has rapidly immersed itself in Western manipulative market practices, in, for instance, adopting the US PPT's Hail Mary algorithm at the end of nearly all trading days, and even more clumsily, admitting its so-called national team will do the European equivalent of whatever it takes to prop up the collapsing historic equity bubble they themselves created. Irrespective, the Shanghai Exchange sits not far from its lows, and with Shanghai futures trading volume down 99%, as speculators realize the Chinese market has been officially rigged, the free market process has been as overtly destroyed in China as it has covertly been so in the States. In other words, as I wrote yesterday, the Eastern central banks passed their own point of no return this month, i.e., going all in on 24/7 manipulation, just as the Western central banks did in mid-2011, along with the Western-led gold and silver cartel. And where has it gotten them? That said, the net effect of all the manipulations is that commodities and currencies remain barely above their 40-year lows. The Dow and Shanghai exchanges are just 1% or 2% lower than they were a few weeks ago, and the benchmark 10-year Treasury yield, which I'll get to shortly, is roughly the same at about 2.2%. And as for precious metals, in what I can only describe as the most blatant, maniacal, unrelenting, heavy-handed suppression tactics since I went all into the sector 13 years ago, gold is down about $20 from $11.25 to $11.05, at least as I write very early Thursday morning, while silver is up about a dime from its also 6-year low of $14.60 an ounce to $14.70. However, what has decidedly changed over this 2-week period is the supply and demand tightness of both metals, but decidedly more so in silver, which is flying off the shelves at nearly the same pace as in 2008. Only this time around, the supply-demand outlook is far more tenuous, given that global silver demand, generally speaking, is twice that of 2008. Above ground available for sale inventories vastly lower, and the future production outlook at perhaps its bleakest in centuries. And no, I'm not overstating. Here at Miles Franklin, August was the second biggest month of demand we have ever had, with the only bigger month being May 2013, just after the April 2013 alternative currency destruction raids, when paper gold and silver prices were viciously attacked to the tune of 15% and 20% respectively in a 2-day period following the now infamous closed-door meeting between Obama and the top too-big-to-fail bank CEOs. Yet, then too, client buying activity was more focused on buying the tip, as gold and silver were still at significantly elevated levels compared to prior years, than protecting life savings. And as for this month, demand has continued at August's pace without skipping a beat, putting Miles Franklin, and likely most of the bullion industry, in a position to match its best year ever in 2011, when the primary driving force was greed as opposed to the far more powerful emotion of fear today. And again, for those that are confused by my description of 2011 as the peak year for bullion demand, I'm only referring to the US and Canadian markets that comprise the vast majority of our sales, as opposed to the Eastern world, where 2013 was the record year for bullion sales, only until 2014 came along and eclipsed it, with 2015 sure to eclipse 2014. Here in the States, dollar-priced gold and silver have been brutally smashed by said cartel, as opposed to around the world where the prices have gone up because of falling currencies, to the point that the mining industry has been perhaps permanently destroyed. Note, Barrick Gold closed at a fresh 26-year low yesterday. And conversely, with an equally maniacal PPT and Fed working relentlessly to support stocks and bonds, the impetus for Americans to buy has steadily weakened for each year since 2011. That is, until now, as frankly, in just a few months' time, 4 years of weakness has reversed dramatically, to the point that 2015 may well eclipse 2011 as the highest ever year of U.S. demand, even if gold and silver prices don't materially move in the year's final 4 months. That said, the odds of gold and silver sitting idly over this period, when the entire global economy is collapsing, and with it countless myriad financial markets the world round, are extremely small. And more so, rapidly decoupling physical prices, but particularly in silver where, as in 2008, it appears increasingly likely that industry supply will completely sell out. Heck, for all intents and purposes, we're almost there now, as in just the 2 weeks since our August 28th special podcast, delivery times on essentially everything have surged to at least 6 weeks and sometimes more. Whilst junk silver has become essentially unavailable at any cost, and premiums on popular products like American Silver Eagles and Canadian Silver Maples surging to levels last seen in 2009, albeit far lower than 2008's peak levels of roughly 100%. To wit, 2 weeks ago, the only products with 6+ week delays were said Eagles and Maples, whilst today, essentially all 1 and 10 ounce rounds and bars have such weights, including generic rounds like Silver Buffaloes. And again, yes, you can find very small sizes still available at online brokers and on eBay, but I do mean small sizes. In other words, if you have any materially sized assets to protect, you're going to wait, unless you want far less liquid 100-ounce bars, which Miles Franklin still sees decent supply of. And by the way, the perhaps last great investment opportunity I referred to in the August 13th article, which was actually titled Silver Supply at a 1.5 or 2.0 out of 10, and one of the potentially last great silver investment opportunities, has not only sold out but surged in price already, i.e. the last of the Royal Canadian Mint's limited edition Bird of Prey series, the Great Horned Owl. Not to mention the third of the series, the Red-Tailed Hawk, which I wrote about personally buying in late July, and has since sold out too, causing its secondary market price to soar as well. Ditto for the limited edition Funnelweb Spider from the Perth Mint, but despite it having since sold out at the Mint, we are still having some limited availability at Miles Franklin, which I expect to sell out shortly. And last but not least, the new .9999 fine Australian Mint 2016 Silver Kangaroo, which have been selling like hotcakes in the worldwide pre-order process, but cannot be shipped until September 21st. Otherwise, as noted above, the only product we currently have available for immediate delivery are 100-ounce bars, which, If 1 in 10 ounce demand remains this strong, will inevitably sell out too. At which point, you can bet your bottom fiat dollar that physical premiums will start to surge significantly, no matter what shenanigans the dying paper cartel attempts. And speaking of the cartel, even I am floored by what I am seeing at the soon-to-be deposed New York COMEX, where in the last 2 days alone, registered, i.e. available for delivery gold, has plunged by an astonishing 42% to an all-time low of a measly 185,000 ounces, worth a paltry $205 million at current prices. Putting this amount in perspective, it is down an incredible 95% from its September 2011 high of 3.4 million ounces and 98% from its September 2011 value of more than 6.5 billion, which, by the way, was still chump change in the scope of global finance. And let's just think about this for a second. At the very second in September 2011, when said dollar price gold hit its all-time high, the Swiss National Bank permanently fiatized the last remaining safe haven currency by pegging the franc to the hyperinflating euro, and the global financial crisis really started to take off. Deliverable gold in the world's largest paper exchange started to vanish, just as it has at the GLD ETF and essentially all other visible inventory caches. And equally so in silver, where both COMEX and Shanghai Exchange inventories have free-fallen as well. In other words, a massive run on already piddling physical supply has occurred since the 2008 and 2011 crises, a time when, I might add, central banks in general have switched from being net sellers to net buyers. And by the way, for those still reeling from the mid-July announcement that the PBOC only added 600 tons to its reported gold reserves since its last update 6 years ago, which I might add I vehemently predicted they would lie about, the PBOC has since quietly reported an additional purchase of 15 more tons in August, or $550 million worth. The COMEX lost 4 tons in just the last 2 days alone, at a time when the PBOC is buying far larger amounts, not to mention financing said purchases with massive U.S. Treasury sales. Gee, I wonder where that gold came from. To that end, Google something just snapped on the COMEX on Zero Hedge, where you'll see a graph of the now parabolic surge in open interest to registered gold inventories on the COMEX, depicting a fraudulent emperor with no clothes exchange in which a record 228 paper claims are currently out on each ounce of supposed registered gold. Yes, my friends, something will indeed give in the coming months, potentially blowing the 2-decade-old 100% covert cartel sky high, just as the equally maniacal but 100% overt London gold pool was in 1968. Only this time, when the world realizes gold has been suppressed via such sales, the stampede for whatever physical inventory still remains will be far more powerful, as will be the attacks on the central banks and governments that purport to be safekeeping such citizens' assets when in fact they have surreptitiously sold, leased, or swapped them away. Of course, the differences between 1968 and today, let alone 2008 and today, are too massive to describe with mere adjectives. Since 1971, when the world contracted fiat currency cancer, global debt and generally speaking, economic deformation have exploded by untold multiples, to the point that the inevitable end game of complete economic and financial collapse, replete with historic political, geopolitical, and social tensions, sits precariously on our doorstep. But hey, you don't need the fringe Miles Franklin blog to tell you so. Instead, just listen to the words of the man most directly responsible for the hell most of the world has already entered, with the majority to join it shortly, i.e. Maestro Greenspan himself, who just yesterday claimed that, quote, debts, deficits, and entitlement programs are all coming to a head in a few months, all over the world. Regarding the very near term, this week's blatantly orchestrated, pathetically inadequate attempts by the PPT to slow the massive global liquidity drain are already starting to show significant signs of strain, starting with yesterday's key reversal from a 200-point early morning Dow gain to a 239-point loss by day's end. Not to mention this morning, when Dow futures were up almost 200 points early in the day, and around now, about an hour from the market opening, they're down to zero. Last night's attempted Shanghai Exchange Hail Mary rally failed too, and after another hideous API crude build, the all but dead oil PPT's latest attempt to revive the world's most important commodity market looks to be retreating as well. Economic data the world round continues to plunge, such as last night's unexpected Japanese capital expenditure decline, the Bank of New Zealand's unexpected rate cut on the heels of a declining economic outlook, and what's this? The death of the BRICS I wrote of last week expanded dramatically last night as the collapsing Brazilian economy was slapped with a junk rating by Standard & Poor's. Which brings me to next Thursday's supposedly all-important FOMC meeting, when frankly the rubber will finally be forced to hit the road. Yes, in the big picture, it's just another Fed meeting, and yes, whether the Fed funds rate is 0 or 0.25% makes not a whit of difference in the global economic outlook. However, given that it will represent the one-year anniversary from when QE3 was officially ended, and I emphasize officially, as I have not a doubt they have been covertly continuing this scheme all along, and thus, if they can't raise rates now, after having incessantly harped about the economic recovery the vast majority haven't seen, the entire world will realize it was a sham all along. And trust me, they would never raise rates in December when their minions on Wall Street count on Fed support of the annual for the annual Santa Claus rallies that pad their bonuses, let alone in 2016 amidst a presidential campaign. Remember, the Fed chairman must be appointed and reappointed by the president. And trust me, if Donald Trump, Jeb Bush, or any other Republican becomes president, Janet Yellen will decidedly not be reappointed. Anyhow, at this point, the whole concept of a Fed rate increase of any kind has become a farce. What with the global economy collapsing, commodities near 40-year lows, emerging market currencies imploding, and even doctored S&P earnings badly listing. Let alone as even stock and bond markets are weakening amidst not only an environment of crisis-like fear, but dramatically declining liquidity, now that traditional investors have been driven out of markets by a combination of catastrophic losses and government commandeering. Even the Fed's mouthpiece, John Hilsenrath of the Wall Street Journal, has been intimating of a dovish Fed for the past 2 months, not to mention the world's #1 recovery propaganda cheerleader Goldman Sachs, and Mr. Atlas Shrugged himself, Paul Krugman. Heck, the World Bank's chief economist just 2 days ago said, quote, the Fed risks triggering panic and turmoil in emerging markets if it opts to raise rates at its September meeting and should hold fire until the global economy is on a surer footing, which, by the way, we won't see for many, many years. Frankly, in my mind, the only reason anyone even thinks there's a chance of a rate hike is because the benchmark 10-year Treasury yield refuses to plunge below 2%, which we now know is due principally to the aforementioned massive Chinese selling, which clearly is being used to finance its insane suicidal support of not only the collapsing Shanghai stock market, but the forward, non-deliverable yuan market, which is plunging far faster than the controlled devaluation the PBC would prefer. In other words, and the opposite of QE is going on right now, or as Peter Schiff and others have called it, QT, quantitative tightening, which clearly the Fed needs to offset with increased money printing. Look, we'll only have to wait a week to find out if the Fed is indeed suicidal. As trust me, I wasn't being flippant, and last week's only one financial event could be as cataclysmic as a significant yuan devaluation. For about 1,000 reasons, from historically overvalued markets to collapsing commodities and currencies, plunging financial liquidity, and an imploding global economy, to name a few, even an infinitesimal eighth of a point increase would likely plunge financial markets into crisis, ignite massive geopolitical tensions, and at one fell swoop, destroy all hope of the economic recovery that never existed and never will. Either way, it's not going to slow down the aforementioned explosive growth in fear, and with it, physical precious metals demand. And thus, we can only reiterate, as vehemently as possible, that the time is now to protect yourself while you still can. Here at Miles Franklin, we have conducted business for 26 years without a single registered complaint, and can help you with not only the purchase, sale, or storage of precious metals, but a variety of financial planning strategies we have honed over 2 decades of working with gold and silver. Consequently, if you are considering the purchase, sale, or storage of precious metals, we simply ask you to give us a call at 800-822-8080 and allow our staff of professionals, on average sporting nearly 25 years of industry experience, to give you a free consultation. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much.